Welcome. I am Eric with Muathe.com, and I greet you, beloveds, in the love and in the light of the one infinite creator. So for today, December 16th, we see the market slightly down, but the NASDAQ is down substantially relative to the S&P 500 and the Dow. NASDAQ is down 424 points. So 424 points down, about 2.75% for the NASDAQ. And if we take a look, one thing that we can observe is that even as the NASDAQ is pulling back, essentially the S&P 500 is still within all-time highs. So that's really what's confusing here. And in fact, if we take a look at the NYSE 52-week lows, we can see that there have been a pickup in 52-week lows. The last time we had a big spike in 52-week lows was in early 2020, of course. And the NASDAQ has seen a pickup in fresh 52-week lows. As you can see, this is the NASDAQ as of the last couple of weeks. Lots of stocks have really gone down quietly. And I say quietly, quote unquote, because the NASDAQ itself is not too far off from its all-time highs. So, as the market and the NASDAQ continue being stable, we are seeing a lot of stocks moving into the 52-week lows category. So maybe there's a message here that maybe this market is changing its makeup from a market that essentially has been very strong, stable at the worst, and for the most part been recording fresh all-time highs every couple months. If we continue seeing that expansion of 52-week lows, chances are we might be going into a market that could change its makeup, and we could see a market that is sideways to potentially down. We shall see. Of course, we have to take it one instrument at a time because each situation is unique and separate. Now, I have to say, one way to avoid being part of this type of frustrating sideways market and then ultimately drifting lower, there's one way to mostly avoid this, and it is to stay consistent with your breakout game. For example, our entry for ZM, which was a big moving instrument in 2020. So ZM, or everybody knows it as Zoom. So our entry when it was showing strength was right there. And of course, there was another breakout attempt many months later. And this is where we start seeing signs of trouble here. This breakout failed. And as I mentioned in a prior video, once this breakout failed, then the risk for sideways to low prices was now on the table. So that failed breakout was a huge red flag. In other words, the momentum was not there. And of course, if it's not moving higher, then it might go into a sideways market. If the momentum is not there to record new highs, then it might eventually drift lower. So I should stress that one of the things that we actually sometimes don't understand, the reason for playing breakouts, is if you're playing breakouts, chances of owning this instrument all the way down are almost zero because there's no breakout since this failed breakout here. Once this failed, this instrument essentially is off your radar. Which now brings me to the reason why I'm using this chart, is we can see here that it met the minimum requirements of the ultimate Muathe breakout here. And actually it met the minimum requirements also somewhere here. These are what we can say were the bullish period and bullish phase. Okay, now the same minimum requirements are now being used in reverse. In other words, they are telling us that this instrument, and I've been talking about this instrument for many weeks, ever since this drop to 3-year lows, which also coincided with the RSI, the MACD moving to 3-year lows. So the risk was always that this instrument could see lower prices. And yes, it has been drifting lower, gradually, but drifting lower. And now at a fresh 52-week low. And you can see that this phase that I am highlighting here, and one that I've talked about in prior videos many times, that stock at that point in time met the minimum requirements for the ultimate Muathe sell signal, which is the exact opposite to the other concept I call the ultimate Muathe breakout. Now there are going to be links in the description of this video explaining this method for free. So if you're interested in understanding what takes instruments lower from being previous winners to turning into bearish candidates, is you need to understand and consider the ultimate Muathe sell signal. And it's a very simple concept. RSI moves to 3-year lows, MACDs move to 3-year lows. That is in itself a warning sign. So for those of us who play breakouts, this instrument is not even in our radar. It's gonna need at some point a breakout, at some point down the road, months and years down the road. A fresh breakout maybe would give us some interest in this name. And so by playing the breakout game, it just means that you can only be interested in an instrument during its bullish phase, and you have no interest in the instrument if it is not breaking out. Which, by the way, brings me to a set of stocks here. We can see ARKK, or what people call ARK. This instrument is also essentially at fresh 52-week lows. And if you take a look at the minimum requirements for your RSI and MACDs, they are also at 3-year lows. And if that ETF, which tracks the large cap technology driven names, then it is potentially also setting the stage that the NASDAQ could be sideways to down. Take a look at the following instrument, CLNE. Now all of these are just random stocks that right now meet the minimum requirements for the ultimate Muathe sell signal. So we can see here this one is getting close to it. Not there, but getting close to that minimum requirements. Take a look at DraftKings, DKNG, which had a good 2020 year, nice 2020 year, but then again after a series of failed breakouts, and of course the failed breakouts are here. After a multitude of failed breakouts, these were red flags right here. Based on the prior monthly closing high right here, this monthly closing high was your breakout level, and it could not hold. All of these were failed instances where prices could not move above the prior monthly closing high. Failed breakout, failed breakout, failed breakout. And now you can see meets the minimum requirements for the ultimate Muathe sell signal. Hence, it's at 52-week lows. And of course, nobody wants to ride these things lower. Nobody. So understanding some of these things makes sense in terms of how to avoid riding instruments to fresh 52-week lows. Here's another stock that had a nice 2020 year. This is very desirable. But you'll notice, again, as I always say, failed breakouts are notorious for taking instruments lower. Here, we failed to break out, and once that breakout failed, the risk for lower prices was there. So, if you play the breakout game and the breakout failed, your exit was somewhere here. Very simple. Because it's not breaking out, it's failing to break out, you get out. Right now, we're at fresh 52-week lows, and again, meets the minimum requirements for the ultimate Muathe sell signal. Ticker symbol FOUR. Same thing. RSI and MACDs are pressing to 3-year lows. So the risk is there for a continuation of this downward move. LVS, Las Vegas Sands, of course. The RSI and MACDs are essentially at or threatening to move to 3-year lows. So if it breaks to 3-year lows on the RSI, that's not good. And if the MACDs continue staying at 3-year lows, this is already an instrument that is showing risky signs of lower prices. Why? Because it meets the minimum requirements for the ultimate Muathe sell signal. Brazilian stock MELI. Likewise, the risk for lower prices and continuation of this 52-week low trend is high, because we can see that the RSI is tethering with a move to fresh 3-year lows. So the risk is still there unless it finds support and holds and moves back above RSI 50 on the monthly. We can see that the MACDs are already at 3-year lows. So lots and lots of risks here. But then again, if you're playing breakouts, you care less because it's not breaking out, it's not of interest. Another stock example here, or LLI. Again, at 52-week lows and momentum still pointing downwards. Not shocking, because again, it already broke to 3-year lows on its RSI on the monthly. And we can see that the MACDs are pressing 3-year lows. So really the move to 3-year lows is consistent with our minimum requirements. And of course, the risk continues for lower prices as long as the RSI and MACDs are all at 3-year lows. Put another way, as long as they continue meeting the minimum requirements for the ultimate Muathe sell signal. Links in the description explain this concept in further detail. A couple months ago, if not weeks ago, I talked about the risk that this instrument could be drifting lower. Here we are at 52-week lows. And of course, the minimum requirements were met many months ago. Once the RSI and MACDs moved to 3-year lows, essentially the risk was there for lower prices. So not a surprise that the stock is trading at fresh 52-week lows. The time to play a name like this is when it's breaking out. This is the only time it's desirable. But over the last couple of months, the exact opposite took place, which is here. We see that the RSI actually just this couple weeks over the last 2 months, moving to fresh 3-year lows. MACDs have been at 3-year lows for a minute, hence recording this move to fresh 52-week lows. A very undesirable ride for those who are holding on, expecting higher prices. And of course, for those of us who play breakouts, once it turned around here and has not attempted another breakout attempt, the stock has been of no interest at all. So naturally, just by playing breakouts, you would never ride this thing down, ever. Oh, I should have mentioned the ticker symbol there, so we're all on the same page. FXIX. Stitch Fix. SPLK at 52-week lows. Not a big surprise. Why? Because the RSI did recently start threatening to move to fresh 3-year lows. And of course, the MACDs are at 3-year lows. Oh, by the way, you might notice that on my MACD settings, I use 2 MACD settings, not just one. So I have 2 MACDs that I follow. As long as one meets the minimum requirements, not both don't have to meet the minimum requirements, just one of them, either one. And if they do meet the minimum requirements, especially in this case when we're looking for visual reasons why some stocks are making fresh 52-week lows, then only one of the MACD is needed. Then again, the method is explained in detail via the links in the description of this video. WB is the next stock that I'm going to mention here. And of course, this one is at 52-week lows, down 26% this month alone. Not fun. And here we can see that the RSI is just newly moving to 3-year lows. So no surprise that it's seeing an even bigger drop. And in this particular example, not even the MACDs are at 3-year lows. So, you know, if this was to make, if the MACDs were and if the MACDs eventually drop to 3-year lows, this stock could be way lower. So right now we are only seeing the RSI at 3-year lows. The MACDs are still not at 3-year lows, so the risk for lower prices in the months ahead are still there. Take a look at Zillow, and also it's been down. Right now it is doing its best to hold this RSI right here. As long as that can hold, it could stabilize and actually create the situation of stability. No breakouts as far as our breakout strategy is concerned. It wouldn't meet the minimum requirements that we look for. But we can see here, if it cannot hold and if the RSI moves to 3-year lows, that's the type of situation you want to avoid, because the risk for lower prices is very elevated. We can see that the MACDs are already trading at 3-year lows. So the risk for a breakdown in price is still there for sure. And the last example in this long video is ZEN, Zendesk. So again, another instrument that had a fantastic, or at least a good run in 2020. These are the desirable months when it's moving higher and when it meets the minimum requirements for breakouts. Right now, the threat for moving to 3-year lows is still there. It's at 52-week lows. But then again, there's possibility that if the RSI cannot hold, and if the RSI continues drifting to 3-year lows, the prices could still go down. And we can see here at least one of the MACDs is already at 3-year lows. In fact, we can say both MACDs are essentially at 3-year lows. So the risk for lower prices remains very high. And again, just want to highlight this concept because if the market is pulling back, we need to know what takes instruments aggressively lower, while reminding all of us that playing breakouts makes sense because it is the only time you get to have an opportunity of riding such a move when it is breaking out and moving higher. Otherwise, if it's not breaking out and moving higher, you have no interest, and by default, you'll never be part of this type of a portfolio erosion. Because if it's not breaking out, it's of no interest. If momentum is lost, then you don't own it. And so it is. I am Eric with Muathe.com, and I leave you, beloveds, in the love and in the light of the one infinite creator. Go forth therefore rejoicing in the power and in the peace of the one creator. Adonai.